On Wall Street, most traders do not lose money because they lack intelligence or technical tools. They lose because they fail to understand the real enemy. And that enemy, more often than not, stares back at them in the mirror. The markets are not cruel. They are neutral, like a vast ocean. But when a sailor does not understand the wind or fears the waves, even calm waters can capsize his ship. That is what trading is: a sea of opportunity for the prepared, a storm of chaos for the unaware. The first lesson every trader must learn is this: you are not trading stocks. You are not trading Forex or futures. You are trading your own beliefs, your own impulses, your own discipline. You are trading yourself. Let us begin with the truth that very few want to accept. Trading is not about being right. It is about being consistent. The majority of people who enter the financial markets arrive with dreams of making millions in weeks. They want to quit their jobs, beat the system, live off the screen, and never answer to anyone again. That fantasy is the first enemy. It is a trap, because trading is not a lottery. It is a profession. And like every true profession, it demands training, patience, and an unshakable understanding of yourself. Think of it this way: if you gave a scalpel to someone who just watched a surgery video on YouTube, would you let them operate on you? Of course not. And yet, every day, thousands of people open trading accounts and start making decisions that could bankrupt them within hours without ever having trained their minds to handle uncertainty, pressure, or loss. Wall Street has a saying: the market is designed to fool the greatest number of people the greatest amount of the time. And it is absolutely true. The market is a master manipulator. It feeds off your fear and fuels your greed. It punishes hesitation and rewards discipline. It will tempt you with easy wins and then teach you painful lessons if you become complacent. The first tool in the professional trader's arsenal is not a chart, not a news feed, not even a strategy. It is self-awareness. A trader must know who they are under pressure. They must understand how they react to loss, how they handle victory, and whether they are truly capable of following a plan when the heat is on. Let us go deeper. In trading, there are three psychological forces that dominate your decision-making: fear, greed, and hope. These are primal. They are embedded deep in the brain, beyond logic. When the market moves against you, fear screams at you to exit. When it runs in your favor, greed whispers to hold on longer. And when you are stuck in a bad trade, hope clouds your mind and convinces you to delay the inevitable. You cannot remove these emotions, but you can learn to manage them. The first step is to track your behavior. Keep a journal. Write down what you feel before, during, and after every trade. Did you enter too soon because you feared missing out? Did you hold too long because you got greedy? Did you ignore your stop loss because you were hoping for a miracle? Every emotional error has a price, and over time, you will notice patterns. Once you recognize those patterns, you can begin to break them. Now, let us talk about ego. Ego is the most expensive emotion in the market. It is the voice that says, "I am smarter than the market." It is the feeling that you cannot be wrong. Ego leads to revenge trading, doubling down on losing positions, refusing to accept defeat. The market does not care about your ego. It only respects discipline. A real trader must learn the art of humility. They must be willing to admit when they are wrong, to take the loss and move on without emotional baggage. Imagine two traders. One believes every loss is an attack on their intelligence. The other views loss as part of the business, like an operating cost. Which one survives? Which one grows? The answer is clear. Trading is not about proving anything. It is about protecting capital and making decisions based on rules, not emotions. Professional traders think in probabilities, not certainties. Every trade is a bet on a likely outcome, not a guaranteed one. Even the best setups fail. That is why risk management is psychological armor. You must size your trades in a way that allows you to lose and continue. The goal is not to win every time. The goal is to stay in the game. Let me tell you a story. There was once a surgeon who trained for over a decade. Every day, he practiced, studied, refined his technique. One day, he meets a man who just read a medical blog and says, "I think I can do this." The surgeon smiles and hands him a scalpel. The amateur panics. The reality hits. That is trading. It looks easy from the outside. The charts move. The profits seem close. But when the pressure is on, only preparation keeps you alive. Another critical point: isolation is dangerous in trading. When you trade alone, with no structure, no accountability, you are at the mercy of your emotions. You need a process, a daily routine, a checklist, just like a pilot before takeoff. Check the markets, review the news, update your watch list, assess your mindset, and then begin. Trading without routine is like sailing without a compass. Many new traders think more trades mean more money. That is a lie. Overtrading is a silent killer. The best traders do not trade every day. They wait. They stalk the market like a predator, patient, calm, focused. They understand that good trades are rare and that capital is precious. They treat every decision like a surgeon treats a scalpel. Precision over frequency. Let us talk about the difference between activity and productivity. A trader who stares at charts for 8 hours but makes no smart decisions is not working. They are reacting. Activity creates stress. Productivity creates results. You must learn to identify the difference. Discipline in trading is not just about following rules. It is about creating a system that makes breaking those rules feel unnatural. That requires internal programming, habits, routines, rituals. Great traders do not rely on willpower. They rely on structure. When you trade by rules, emotions have no room to sabotage your decisions. And then comes the most powerful concept, detachment. Detachment means you do not take trades personally. You do not celebrate wins as validation or see losses as attacks. You view each trade as one in a long series. Your self-worth is not tied to the outcome. That is the mindset of a pro. A detached trader sees clearly, acts decisively, and sleeps peacefully. Trading is not about predicting the future. It is about reacting intelligently to the present. You are not a fortune teller. You are a risk manager. Every candle on the chart is a vote of the crowd. Your job is not to argue with it. Your job is to interpret it, to find the signal in the noise, and to make a decision based on logic, not emotion. The final lesson of this chapter is simple but vital. Treat trading like a business. That means tracking your numbers, reviewing your performance, studying your wins and losses, creating a business plan, evaluating your edge, setting goals. You are not just a trader. You are the CEO of your trading enterprise. Great traders do not chase excitement. They pursue mastery. They are not addicted to the screen. They are addicted to growth, and growth requires pain, discipline, and ruthless honesty. So the question is not, how do I win in the market? The real question is, who do I need to become to survive and thrive? That is the beginning. That is where the real journey starts. Not on the screen, but within you. Your first job as a trader is not to beat the market. Your first job is to beat the version of you that panics, that hesitates, that breaks rules, that needs to win. When you conquer that part, the market becomes easier. It becomes a game of logic, not emotion. And that, dear reader, is the mark of the true trader. Most people believe charts are meant to predict the future, but that's a misunderstanding shared by beginners, dreamers, and gamblers alike. The truth is far more practical and far more powerful. A chart is not a crystal ball. It is a map of emotions, decisions, battles, and ultimately consequences. Each candle on that chart is a sentence. Every volume spike is an exclamation point. Every trend line is a paragraph in the story that the crowd is writing in real time. The more fluently you read that story, the less surprised you are by its twists and turns. Just as a seasoned doctor reads an X-ray and immediately detects a fracture invisible to the untrained eye, a professional trader scans a chart and sees psychological fractures, emotional buildups, pressure points, and exhaustion patterns. These are not mystical symbols. They are the digital fingerprints of collective human behavior. To understand price action is to understand the crowd. The crowd buys because it feels hopeful, sells because it feels scared, and holds because it is confused. Your job as a trader is to interpret those emotions, translate it into price, and respond not emotionally, but strategically. So let us begin. The naked truth behind the chart. Imagine standing at Times Square and watching 1,000 people react to a rumor spreading through the crowd. Some rush forward, others hesitate, some flee. The direction in which most of them run is what we call the trend. Their hesitation becomes consolidation. Their panic becomes a reversal. Price action is nothing more than the organized chaos of mass psychology, plotted point by point. When price climbs steadily, it is not because the asset is destined to rise. It is because enough participants believe in its upward potential until doubt seeps in. That doubt creates pullbacks. When enough traders decide the party is over, price falls. This is not prediction, it is perception. And perception is what moves markets. The more you watch charts without indicators, the more clearly you begin to see the raw emotion behind every movement. Candlesticks become the language of fear and greed. Long wicks scream rejection. Engulfing candles signal emotional reversals. Sideways ranges are confusion. Breakouts are relief or panic. Every pattern, every pause, every spike tells a psychological tale. Charts do not lie. Traders do. Technical indicators. Assistants, not masters. Many traders start by crowding their screens with indicators: MACD, RSI, stochastic, Bollinger Bands, moving averages. They hope that if they use enough tools, they will unlock some hidden truth. But what they often create is noise, a symphony of contradiction. Let's be clear, indicators are not bad, they are useful, but they are secondary. Price action comes first, always. Indicators are your assistants, not your compass. They confirm what price already hints at. They do not speak before price, they echo it. Take the MACD, moving average convergence divergence, for example. It is not there to predict a move. It shows you the momentum behind the move. When the MACD line crosses the signal line, it often reflects a psychological shift, enthusiasm turning into hesitation or fear, turning into renewed buying. But if you look closely, you will often see that price action already hinted at that shift before the MACD caught up. The EMA, exponential moving average, smooths the noise and helps you track trend strength and health. A rising EMA slope often reflects a confident crowd. A flattening EMA reveals indecision. When price tests and respects the EMA repeatedly, it reveals respect from the crowd, a behavioral confirmation. Then there is the force index, a less mainstream but potent indicator created by Dr. Alexander Elder himself. It measures the strength of bulls and bears by combining price and volume. A rising force index with rising price confirms a strong buying wave, but a divergence, a situation where price makes new highs but force index weakens, can signal hidden exhaustion. That is psychology in motion. Indicators are tools. Use them like a pilot uses instruments, not as substitutes for looking outside the window, but as checks to support what your trained eyes already suspect. Spotting reversals. When the crowd changes its mind. Trends do not end by accident. They end when belief changes. A rally ends when buyers run out of courage. A sell-off ends when fear reaches exhaustion. And if you watch closely, the chart always gives hints. Look for divergences. If price continues to climb but momentum indicators begin to fall, that is a red flag. The crowd is getting tired. New highs are being made on weaker enthusiasm. Reversals often begin not with fireworks but with whispers. Watch volume. A surge in price without volume support is suspicious. It is like a cheer without a crowd. But when a breakout is accompanied by volume flooding in, that is a vote of confidence from the crowd. Observe structure. Markets move in waves: impulse and correction, expansion and contraction. Reversals often form clear patterns: head and shoulders, double tops and bottoms, wedges. These are not just visual patterns. They are behavioral transitions. A double top, for instance, is a moment when the crowd tries to push higher, fails, tries again, and gives up. That giving up is what creates the fall. Pay attention to traps. False breakouts suck in late buyers and punish them immediately. They are psychological bear traps and bull traps. They create pain, and pain triggers reversals. When price briefly breaks a level and then sharply reverses, it is often a trap revealing the market's true intention. Confirming the trend. Is the crowd still committed? In trend trading, you are not looking for tops and bottoms. You are riding waves. And the key to riding waves is confirmation. Ask these questions. Is price making higher highs and higher lows in an uptrend? Is the trend line respected by the market? Are moving averages aligned in the direction of the trend? Is volume increasing on trend continuation and decreasing on pullbacks? When the answer is yes, the crowd remains committed. But when price begins to falter, when it breaks the trend line with conviction, when moving averages start to flatten or cross against the direction of the trend, those are signs the crowd is losing faith. The trend is not over until the market says it is. And the market speaks through price structure, volume, and momentum alignment. Combining indicators without cluttering your vision. Here's a hard truth. The more indicators you use, the less clarity you often have. Think of indicators like ingredients in a dish. A great chef uses only what enhances the flavor. More spices do not make a better meal, they often ruin it. Likewise, you do not need 5 indicators to tell you what 1 or 2 can confirm. A practical setup might look like this: price action and candlestick patterns as your primary input, EMA to track trend direction and dynamic support or resistance, MACD or RSI to measure momentum and confirm strength or divergence, volume or force index to validate conviction. That is all you need. The rest is noise. If indicators begin to contradict each other, trust price first. Always. Indicators should align like a choir, not argue like a committee. If one says up and the other says down, step aside. Clarity is your friend. Confusion is a cost. Training your eye. The doctor's discipline. Reading price is a skill. It is not a gift. You do not need to be born with intuition. You need screen time, observation, and repetition. Review charts daily. Pick a single instrument. Watch it evolve over days, weeks, and months. Study how trends begin and end. Learn how pullbacks behave in strong versus weak markets. Replay historical charts. Watch what came before the big moves. What did the candles say? What did the volume do? Was there a trap, a fake out, a divergence? These lessons are free and priceless. One of the best exercises is this: hide the right side of the chart and make decisions based only on the left side. Practice entering, placing stops, and managing trades. Then reveal what happened. This trains your mind to act on structure, not hindsight. Remember, a doctor does not diagnose by guessing. They look at patterns, they rule out noise, they compare, they measure. A trader must do the same. Price tells the truth. Indicators assist, emotions sabotage. Trading is not about making money. It is about keeping it. That truth sounds simple, but it separates the amateurs from the professionals. In every corner of the financial world, the rookie's focus is always the same: how much can I make? The professional, in contrast, asks a different question: how much can I lose and still be alive tomorrow? This is not just a mindset, it is the foundation of survival. Risk is not your enemy. Uncontrolled risk is. Risk is the price of entry into this game. It is the toll you must pay to play. The goal is not to avoid risk. The goal is to manage it so well that no single trade can break you, no string of bad luck can destroy your capital, and no moment of weakness can erase years of discipline. The illusion of winning streaks. Let us start with a hard reality. You can win 6 trades in a row and still lose everything on the 7th. That is not theory. That is how most traders go broke. They get a few wins, confidence builds, position size increases, rules start to bend. And then, without warning, the market teaches its harshest lesson. One bad trade, one oversized position, one emotional decision, and suddenly the account is bleeding. This is the fatal illusion that recent success equals future safety. But trading is not linear. It is probabilistic. Winning streaks lull you into a false sense of security. But if your risk is not capped, it only takes one mistake to wipe out days, weeks, or even months of progress. Imagine a trader who risks 10% of their account per trade. They win 6 in a row and grow their account by 60%. But then comes one loss, 10% down. It hurts, but not fatal. The second loss comes, another 10%. Now emotions stir. They double down on the next trade, trying to recover faster. That trade loses. Suddenly, in just a few steps, the account has lost 30 or 40%, and the psychological damage begins. Panic sets in. Strategy disappears. What's left is emotional trading, revenge trades, desperation. The game is over. That trader did not lose because they were wrong. They lost because they risked too much when they were right. The 2% rule, Elder's safety net. This is where Dr. Alexander Elder's famous rule comes in. It is deceptively simple, but profoundly powerful. Never risk more than 2% of your capital on any single trade. This does not mean you only use 2% of your capital to place a trade. It means the total potential loss on that trade, if it hits your stop loss, must not exceed 2% of your total account value. Let us break it down. Suppose your trading account is $100,000. 2% of that is $2,000. That means your worst case loss on any trade should not exceed that amount. If you are trading a stock or futures contract, calculate the distance between your entry and your stop loss. Then determine how many units you can trade while keeping your potential loss under the $2,000 threshold. This rule protects you in 2 ways. First, it limits damage. Even if you suffer 5 losses in a row, your account is only down 10%. Not ideal, but manageable. You are still in the game. Second, it controls your emotions. When you know your maximum risk in advance, fear shrinks. You are not trading your rent money. You are trading a controlled portion of your capital. That detachment brings clarity, and clarity leads to better decisions. Some traders argue that 2% is too conservative. They want more action, more size, more potential return. But they are thinking short term. Professionals think in decades. The 2% rule is not designed to make you rich quickly. It is designed to keep you solvent forever. Hatcher drawdown, the real cost of recovery. Every trader needs to understand one brutal truth about drawdowns. The deeper you fall, the harder it is to climb back. A 10% loss requires an 11% gain to break even. A 25% drawdown needs a 33% return. A 50% drawdown? You must double your money just to get back to where you started. Let that sink in. The market is a brutal teacher. It gives the test first and the lesson later. Every dollar you lose is not just a financial hit, it is a psychological wound. And the deeper that wound, the more likely you are to abandon logic and chase losses. That is why professional traders obsess over drawdowns. They track them religiously, not just in live trading, but in backtesting. They design their strategies to withstand the worst. Because they know survival is the name of the game. Profit comes later. First, protect the base. Expectancy, thinking like a casino, not a gambler. Most people approach trading like a gambler. They look for the next win, the next jackpot. But professionals think like a casino. They do not care about the outcome of any single trade. What matters is the edge over 100 trades. This is where the concept of expectancy comes in. It is the average amount you can expect to win or lose per trade based on your system statistics. Here is the formula. Expectancy equals win rate times average win, loss rate x average loss. Let us say your system wins 50% of the time. Your average win is $3,000. Your average loss is $1,500. Your expectancy equals 0.5 times 3,000 minus 0.5 1,500 equals 1,500 minus 750 equals $750 per trade. That means that over a large number of trades, you can expect to make $750 per trade on average, even though you are only winning half the time. This is why win rate alone means nothing. You can win 90% of your trades and still lose money if your losses are too large. You can win only 40% and still be profitable if your winners are bigger than your losers. Expectancy forces you to think statistically. It removes emotion from performance. You stop chasing high win rates and start optimizing your edge. A trading system is not a magic formula. It is not a secret code whispered in back rooms of Wall Street. It is not an algorithm that guarantees riches. A trading system, in its purest form, is a mirror. It reflects your beliefs, your fears, your experience, and most importantly, your behavior under pressure. It is a deeply personal construct, and if built correctly, it becomes your greatest ally in the markets. Before you build your system, understand this. The market does not care about you. It does not care about your education, your backstory, or your dreams. It is not here to reward your effort. It only rewards consistency and discipline. Your system is the shield that protects you from the chaos. It is the structure that turns randomness into order, emotion into logic. From instinct to strategy. Every trader begins with instinct. You see a chart, you feel something. Maybe a pullback seems ripe for a bounce. Maybe a breakout feels like a trap. That intuition is the raw material. But raw material by itself is useless. A professional does not rely on gut feelings. A professional refines those instincts into rules. How do you make that leap? Start by documenting your trades. Write down why you entered, why you exited, what the result was. Look for patterns. Do you consistently spot trend reversals? Are you better at riding momentum? Do you panic during consolidation? The answers lie in your own data. Over time, your experience becomes a map. That map becomes your strategy. A good system is not built in a day. It evolves. You do not create it in isolation. You discover it through failure, through reflection, and through iteration. You test, you tweak, you retest. Eventually, your rules become second nature. But first, you must define them. Defining entry, exit, and reversal. Let us break down the three core elements of any trading system: entry, exit, and reversal. Entry. This is your trigger. What condition must be met for you to place a trade? Maybe it is a price breakout above a key resistance level, confirmed by rising volume. Maybe it is a pullback to a moving average during an uptrend. The point is, your entry rule must be clear and repeatable. It should not change based on how you feel that day. It should not depend on headlines or hunches. Exit. Every trade must have a planned exit. This includes a profit target and a stop loss. Your stop loss is your insurance policy. It is the price at which you admit the trade did not work. Your profit target is your payday. Some traders use fixed ratios, like a 2-to-1 reward to risk. Others trail their stop behind the price as it moves. The method is yours to choose, but the rule must be strict. Reversal. What tells you the trend has changed? Reversal signals are critical for trend traders. This could be a break of a key moving average, a momentum divergence, or a failed retest of a high. Whatever the signal, define it. Write it down. Know it when you see it. A system is a checklist. It is a series of if-then statements. If condition A is met, then take action B. Remove the guesswork. Your goal is to make trading as mechanical as possible, not because you want to be a robot, but because you want to remove emotion from decision-making. Back testing without lies. Most traders lie to themselves when they backtest. They scroll through charts, find the points where their system would have worked, and ignore the rest. That is not backtesting. That is fantasy. Real backtesting is systematic. You define your rules. You apply them to historical data. You record every trade your system would have taken. You track the win rate, average gain, average loss, drawdown, and expectancy. Only then do you know if your system has an edge. Beware of curve fitting. If your system performs perfectly on past data but fails in live trading, it was likely tailored too tightly to that data. A good system performs reasonably well across different instruments, timeframes, and market conditions. It is robust, not perfect. Use software if needed. But even a spreadsheet is enough. What matters is that your process is honest. A backtest is not a promise. It is a probability, and it is your first step toward professional confidence. Simulated trading. The trader's flight simulator. A pilot does not fly a plane the first day he enters aviation school. He spends hundreds of hours in a simulator. Why? Because real-world mistakes are costly. Trading is no different. Before you trade with real money, test your system in a simulator. There are many platforms that offer paper trading. These simulate real market conditions without financial risk. But do not treat it like a game. Respect the simulator as if your real money were at stake. Use your actual system. Follow every rule. Record every trade. Review your performance weekly. Look for mistakes, hesitations, emotional overrides. You are not just testing your strategy, you are testing yourself. Discipline must be trained. Confidence must be earned. When your simulated results are consistently positive and your behavior is stable, you can transition to real capital. But even then, start small. You must prove you can survive before you scale. When to adjust, when to stand firm. No system is perfect forever. Markets evolve, volatility changes, new patterns emerge. A trader must adapt, but not too often. Constant tinkering destroys consistency. So how do you know when to adjust? Use data. If your system suddenly performs poorly, do not panic. Analyze. Is it a short-term anomaly or a structural flaw? Look at your trade log. Are you executing the system correctly? Are your rules being broken? If the system is sound but execution is sloppy, fix yourself. If the system is no longer aligned with market behavior, consider adjustments. But never change your system based on a few bad trades. That is emotional sabotage. Set a review period. For example, every 20 trades or once a month. Only then do you allow yourself to evaluate changes. This forces patience. It creates a buffer against impulse. Also, protect the core. You can tweak entry filters or exit techniques, but the foundational logic must remain. If you abandon your edge, you start from zero, and zero is a dangerous place. The victory of consistency. Most traders chase wins. They look for strategies that promise instant success, but the best traders chase consistency. They understand that 100 small, disciplined wins are more powerful than one giant, lucky spike. Consistency comes from clarity. Clarity comes from structure, and structure comes from having your own system, a system that matches your psychology, fits your schedule, and reflects your strengths. Build that system like an architect. Test it like an engineer. Execute it like a pilot. Review it like a CEO. It is your business, and it will reward you in proportion to your discipline. Winning in trading is not random. It is not luck. It is earned. And the system you build is your blueprint, your compass, your edge. Never forget, victory is the reward for consistency, not chance. Trading is not a game. It is not a thrill ride, a casual hobby, or an escape from the mundane. It is a business, a real one. And just like any serious business, it demands structure, accountability, capital discipline, strategic growth, and above all, professionalism. The mistake most aspiring traders make is romanticizing the act of trading. They picture themselves in front of multiple screens, making lightning-fast decisions, living off adrenaline and instinct. But the professionals, the ones who survive and thrive, operate differently. They build their trading practice like a company. They assume the mindset of a CEO. They do not just trade, they manage a portfolio, a process, and a personal enterprise. Building the foundation. Your trading desk is your headquarters. Walk into the office of a high-level executive and you will not see chaos. You will see clarity. Everything is organized, deliberate, optimized for performance. Your trading room should be the same. Start with your physical environment. Where you trade influences how you trade. Your desk should be clean, quiet, distraction-free. Your screens should be arranged with purpose. Charts, news feeds, watch lists, and execution platforms positioned logically. Lighting should be comfortable. Your chair should support long hours without fatigue. More importantly, your mental environment must match. Your trading station is not your gaming setup. It is not your Netflix corner. It is your control room. When you sit down to trade, you are clocking in. You are entering a high-performance zone where emotions take a backseat and execution takes priority. Professionals treat their space with respect. They prepare it before the session. They clean it after. They run their day from it like a commander in a war room. Because they know when your environment is sloppy, your execution will follow. Operating like a CEO. Strategic planning and process discipline. A CEO does not wake up and randomly decide what to do with their company each day. They follow a plan. They lead based on data. They evaluate progress weekly, monthly, quarterly. You must do the same. Start with a weekly trading plan. Each Sunday or before the market opens, review key economic events, earnings reports, sector rotations, and macro trends. Build a watch list based on setups aligning with your strategy. Define your risk parameters for the week. How many trades will you take? What is your maximum exposure per asset or per day? Next, implement a daily execution plan. Before the opening bell, define your targets, set alerts, recheck your system rules, confirm your risk controls. Prepare mentally. Visualize sticking to your process, not chasing outcomes. After the session, review your trades. Log every entry and exit. Write why you entered. What was your logic? Did you follow your system? Did emotions intervene? Grade yourself not on profit, but on execution. This is your daily P&L, not profit and loss, but process and learning. When you approach each day like a business leader, making decisions with a plan, evaluating results with honesty, you separate yourself from the majority who trade reactively. Budgeting risk capital like a financial controller. Every successful business has a budget. It controls costs, forecasts growth, and ensures survival through lean periods. Your trading capital is no different. It is not money to play with. It is money to manage. Set clear risk allocations. Decide what percentage of your account you are willing to risk per trade. Professionals rarely exceed 1 or 2%. Then define your maximum daily and weekly drawdown limits. This is your circuit breaker. If hit, you stop trading and reassess. Track your cost of doing business. Platform fees, data subscriptions, commissions, slippage. All of these eat into your profit margin. You must know your break-even point. Trading without understanding your cost structure is like running a business without knowing your overhead. More importantly, understand capital efficiency. Your goal is not just to avoid losses, but to make your capital work smarter. Learn to scale in and out of positions. Rotate capital into higher probability setups. Keep idle capital ready for opportunity, but never overlever. The business-minded trader treats capital like inventory. Measure it, protect it, deploy it Only when there is edge. Tracking metrics. Data is the CEO's compass. Data-driven decisions separate amateurs from pros. Every trade you take is a data point. Every pattern you trade, every loss you incur, every win you bank, they all speak if you are willing to listen. Establish a trading dashboard. Track key performance indicators, KPIs. Win rate, average win versus average loss, risk-reward ratio, expectancy, maximum drawdown, monthly return on equity, number of trades per strategy type. These metrics tell you what's working and what's not. They show where your edge lives and where it disappears. Review them weekly. Identify outliers. If your win rate drops but your reward risk improves, your system may still be sound. If drawdown is rising, investigate your discipline or market context. Data removes delusion. It silences the ego. It lets you optimize your business not by how you feel, but by what the numbers say. Planning for sustainable growth. No serious business stays stagnant. Growth must be intentional. But growth in trading is not about adding more screens or taking more trades. It is about compounding skills, discipline, and capital. Build a scaling plan. For example, after 6 consecutive profitable months with a stable drawdown, increase position size by 10%. Or expand into a second asset class, like moving from equities to futures, only after mastering the first. Growth also means diversifying your edge. Maybe you trade breakouts well, but struggle in choppy markets. Build a secondary system for range conditions. Maybe your edge exists in short time frames. Test whether swing trading can complement that. Avoid the trap of more is better. More trades, more leverage, more action often destroy consistency. Strategic growth is boring, but it is effective. It is not about excitement. It is about control. Professional development. Investing in the trader behind the screen. A profitable business invests in its people. You are that person. Your skill set, mindset, and energy levels determine your outcomes. Invest in education, not in chasing strategies, but in deepening your understanding of market mechanics, behavioral finance, and system design. Take notes, test ideas, read industry research, attend workshops where real professionals teach. Invest in health. No business thrives if the operator is burned out. Set a routine. Sleep, exercise, breaks during the session. Your brain is your trading engine. Keep it sharp. Invest in coaching or mentorship. Even the best CEOs have boards of advisors. Find traders ahead of you. Learn from their mistakes. Let someone hold you accountable when emotions cloud your vision. Your business is only as strong as the trader running it. Emotional neutrality. Leading with logic, not noise. A CEO does not scream with joy after a good sale or spiral into despair after a poor quarter. They stay even, strategic, focused. That is the emotional posture you need in trading. Detach from individual trade outcomes. Each trade is one of hundreds. One result means nothing. What matters is consistency over time. Design rituals that reinforce neutrality. Maybe you meditate before trading. Maybe you journal after every loss. Maybe you review charts without looking at P&L first. Build habits that keep emotion out of the room. Over time, this neutrality becomes your edge. Others will panic when volatility spikes. You will execute. Others will get greedy after wins. You will reset. This is what separates a real business from a casino mindset. Building longevity, from hustle to legacy. Many traders burn out within a year. They approach trading like a sprint, but a real business thinks in decades. It focuses on endurance. Design your trading business for longevity. That means automation where possible, clarity in execution, and sustainable workload. You should be able to trade the same system 10 years from now with only minor adjustments. Build reserves, both financial and emotional. Save part of your profits. Avoid overtrading. Take breaks before the market forces them on you. Create a mission. Why do you trade? Freedom, legacy, control over your time? Anchor your business in a purpose larger than profit. When you run your trading with the seriousness of a CEO, the patience of an investor, and the humility of a student, you become not just a trader, but an architect of a profitable, sustainable future. Because trading is not meant to make you excited, it is meant to set you free. Trading is a journey, not a shortcut, not a lottery ticket, and certainly not a show for thrills. It is a craft, it is a profession, it is a business. And if you approach it with the mindset of a disciplined CEO, the heart of a lifelong learner, and the calm of a seasoned risk manager, you will not just survive this game, you will outlast and thrive. Let your trading room become more than just a corner with screens. Let it be your command center, your creative studio, your war room, and ultimately, your freedom space. Thank you for spending your time and an energy diving deep into this chapter. If you found value in this, if it sparked a new perspective, or helped you see trading from a sharper lens, I invite you to join our growing community of serious traders and thinkers. Subscribe to Trading Mindset Lab, where we don't chase signals, we train minds. We're building more than a channel. We're building a movement grounded in psychology, driven by discipline, and powered by data. Stay sharp, trade smart, and remember, the market rewards those who treat it like a business.